Growth-oriented, capex-led, as well as balanced. These are the words that are being used to describe Union Budget 2023, as the government has done the job of walking the tightrope between capex as well as fiscal prudence very efficiently in this budget. Let me run you through the key details at this point of time. Now, as far as the capex is concerned, the target has been increased substantially. So the capital expenditure is now pegged at 10 lakh crore rupees for FY24, and that's an increase of 33% on a year-on-year basis. The street was actually expecting a growth of maybe 10 to 12% as far as capex is concerned, but this is a big jump coming in for the entire capital expenditure. Despite doing that, the fiscal deficit for FY24 has been pegged at 5.9%, and this is bang in line with what street was expecting. In fact, for FY23, however, the fiscal deficit stands at 6.4%. In addition to the capital expenditure, they have talked about the various verticals where it's likely to increase. For defense, for instance, we have seen an uptick of around 6% in the total outlay. For railway, the total outlay stands at 2.4 lakh crore rupees. A part of the street was expecting a number close to 2 lakh crore rupees. So a tad bit of improvement from there on. Separately, even if you look at the personal finance side, the government has managed to give quite a bit of exemption and freebies when it comes to the mass as well, because what they have done is increase the tax slab for the middle class, and that is something that will really go well down with the citizens as well, given that the sticky inflation has been eating into the pockets of the citizens. So for instance, they have proposed the income tax rebate to be increased to 7 lakhs under the new tax regime, and the overall tax slabs have been revised upwards as well. Plus, for the high net worth individual, the surcharge has been cut down to 25%. So a lot of incentives coming in when it comes to the new tax structure, and maybe the government wants really to wants the citizen to move away from the old tax regime to the new tax regime, and that's why these measures were brought in. Separately, talking about the energy transition, that was a key focus area for the government yet again. A 35,000 crore outlay has been laid out for that, and they have reiterated their targets when it comes to the net zero visibility as well as green hydrogen production, wherein the target has been set at 5 mmmt by 2030. Separately, as far as the auto sector is concerned, the government has extended their scrappage policy for government vehicles as well as ambulances, so that continues to be on track as well. Plus, there was a lot of announcement when it comes to tourism sector. 50 cities have been designated for development, and that's something which should augur well. And also, new airports as well as aerodromes have been announced as part of the union budget. There was a lot of focus when it comes to rural income, agri as well as fisheries, dairy, etc. as well. So for instance, for the farm credit limit, that has been raised to 20 lakh crore rupees in FY24, and spending on fishery sectors planned at a whopping 6,000 crore rupees. However, there were some misses when it comes to the budget as well. The first miss actually came in for cigarettes, wherein the tax or the NCCD, which is the National Calamity cess, which is there, was increased by 16% on cigarettes, though the street verdict is that this increase is lower than what they expected, and that's why we saw the stock of ITC rally by the end of the trading session. In terms of the other misses, the defense outlay was a tad bit lower than expected. There were also certain there was no benefit that came for the OMCs as well, so that was a tad bit of negative. Plus, the other space which took it on the chin today was clearly the insurance stock. Now, they were coming under pressure at certain exemptions which were available earlier on for the people who had their premiums higher than 5 lakh rather, has been taken away. So that has put some sort of a negative impact for insurance companies. Plus, the fact that the government is now focusing away from the ATC benefits makes people believe that the entire luster or shine of insurance will go away, and the consumer behavior will change away from insurance. So that's another reason why we saw that stock under pressure. But otherwise, have to say it was a very balanced budget. In fact, the whole host of experts that we spoke with have been rating the budget anywhere between 9 to 11, 12, and that comes in on a factor of 10. So very progressive, growth oriented budget, and that's what was the verdict coming in from the capital markets as well.
If you like this video, then like, share and subscribe to ET Now.